A company can show record profits on its income statement, yet simultaneously run out of cash and face immediate insolvency. Accrual accounting maps economic events. It records revenue when a sale is made and matches expenses to that revenue, but it does not map the hard reality of physical liquidity. As operating profit climbs on paper, the actual cash balance can easily dip below zero. To survive, finance departments build a master cash budget. This mechanical tool takes the accrual-based operating budget and applies specific temporal modifiers to forecast an exact timeline of liquidity. Building this timeline requires 3 steps: mapping the exact lag between purchases and payments, stripping out non-cash accounting accruals, and adjusting for shifting balance sheet accounts. The objective is to pinpoint the specific weeks or months when the firm will face a cash deficit requiring outside financing or generate excess capital ready for investment. Without translating abstract operating goals into a timeline-driven model of cash, decision-makers are flying blind, assuming that paper profits equal money in the bank. We begin constructing the master budget at the most granular level, projecting the physical outflow of cash to pay for raw materials. The exact timing of these outflows is dictated by credit policies and purchase terms. Loose credit delays cash receipts, while taking advantage of supplier discounts accelerates cash outlays. These policies alter the timing of raw operating expenses. This is a standard materials cash disbursement schedule. It demonstrates how specific payment terms break a single expense into overlapping cash requirements across multiple months. Look at the payment policy for the supplier. The company pays 60% of its current month's purchases immediately, while paying off the 40% remainder from the prior month. Trace the math for Material A. In April, the projected accrual expense for raw materials is $56,256. Under the 60-40 rule, that single expense splits into 2 cash outlays. $33,754 is paid immediately in April. The remaining $22,502 obligation shifts into May. At the same time, the 40% unpaid balance from the prior month's purchases, made in March, creates an $18,000 cash obligation that drops directly into April's column. This split payment schedule creates an overlapping cascade of obligations. It proves mathematically that a single month's operating expense is rarely equal to that month's required cash outlay. Moving from variable materials to fixed operating costs introduces a different challenge. Analysts must avoid treating every ledger expense as a physical cash outflow. This table lists annual fixed operating costs. To build an accurate forecast, we have to identify which of these line items actually impact the cash balance. Firm, instructive tone. Depreciation is a purely accounting-based allocation of past capital expenditures. It uses no current cash and must be entirely stripped out of any liquidity forecast. The remaining costs must be categorized by their payment frequency. Salaries typically represent an evenly distributed monthly expense. Items like insurance and property taxes hit the budget in large, irregular lumps. The $18,000 annual insurance expense, the contract terms dictate strict quarterly payments hitting in January, April, July, and October. Failing to isolate these targeted quarterly hits results in an artificially smooth forecast, leaving the company unprepared for sudden cash drains. When building a top-down master budget from high-level projections, analysts must also adjust for changes in working capital accounts on the balance sheet. This projection asks us to find the estimated cash disbursements for inventories, given the sales, gross margin, and expected changes to balance sheet accounts. First, we calculate the baseline cost of goods sold. With $2.4 million in sales and a 40% gross margin, the actual cost of goods sold is the remaining 60%, or $1.44 million. Next, we account for the $60,000 decrease in inventories. A shrinking inventory means the company sold off existing stock rather than purchasing new units, requiring less cash out the door. We subtract $60,000 from the baseline cost. Finally, we factor in the $100,000 decrease in accounts payable. To reduce a payable balance, the company had to burn cash settling prior debts. This requires more cash out the door, so we add $100,000 to our running total. $1.44 million minus $60,000 plus $100,000 yields a precise cash estimate of $1.48 million. Ignoring inverse balance sheet movements will drastically miscalculate physical cash needs, particularly during periods of rapid growth or contraction. All of these localized schedules, the material delays, the non-cash adjustments, and the balance sheet shifts, are ultimately consolidated into the master cash budget. This consolidated quarterly budget starts by adding the beginning cash balance to customer collections, establishing the total cash available for the period. From there, we drop down and subtract the total accumulated disbursements calculated in our previous granular steps. But there is a final hurdle. Corporate policy or debt covenants frequently require a mandatory minimum cash reserve. Here, a desired ending balance of $100,000 must be held back. Subtracting the required disbursements and the $100,000 reserve from the available cash leaves an April deficit of over $53,000. This final row is the true operational trigger for the finance team. It translates historical accounting data into a forward-looking distress signal. We can see the precise value of the model by comparing the severe cash deficit projected in April to the massive $167,000 surplus projected for the exact same company by June. Seeing this deficit months in advance allows the firm to plan ahead. They can tap a revolving credit facility or secure short-term borrowing long before the cash actually runs out. Conversely, projecting the June surplus allows the firm to optimize its capital efficiency. That excess cash can be deployed to pay down debt, invest in new projects, or issue a planned dividend to shareholders. This level of preemptive execution is impossible with a standard accrual-based profit and loss statement. The master cash budget is the definitive strategic roadmap. It ensures that a profitable enterprise actually remains solvent in the real world.